me ask you something. You wake up this morning, make your coffee, check your bank account, and everything looks fine. Rent paid, bills covered, maybe a little left over. You're doing okay. Not great, but okay. Here's the thing, though. Somewhere in Washington, D.C., a number exists that is quietly, slowly reaching into your wallet. And the wild part? You didn't sign anything. Nobody asked your permission. You didn't vote on it, but it's happening anyway. That number is $39 trillion. And I know what you're thinking. That's a government problem. That's a politician problem. That's not my problem. And look, I get it. That's what I used to think too. But stay with me here, because by the end of this video, you're going to see exactly how that number shows up in your grocery bill, your rent, your mortgage rate, and the savings account you've been trusting your entire life. And once you see it, you can't unsee it.
So let's start with a simple question. What even is national debt? Think of it like this. Imagine your neighbor. Nice guy, decent job, but every single month he spends more than he earns. So what does he do? He borrows from family, from banks, from credit cards, and he keeps borrowing for years, decades. Now imagine that neighbor has a $39 trillion tap. That's the United States of America right now. The national debt has crossed $39 trillion. That's more than 120% of the entire country's GDP. The last time America's debt was this high relative to what it produces? World War II. And back then, at least there was a war to point at. But here's what really gets me. It's not just the number, it's the speed. The interest payments alone, just the interest, not even paying back the actual debt, crossed $1 trillion a year back in 2024. That's more than the entire U.S. defense budget, more than Medicare. The government is spending more money just on interest than it spends on keeping people healthy or keeping the country safe. And nearly 1/3 of all that debt, about $10 trillion, comes due this year, 2026. It has to be refinanced, rolled over, borrowed again. Except now, interest rates are way higher than they were 5 years ago. So what happens when you have to renew a massive loan at a much higher rate? You pay more, a lot more, every single year.
Now, this is where it gets personal. And this is the part nobody explains properly. When the government needs to borrow money, it issues something called treasury bonds. And who buys those bonds? Pension funds, banks, foreign governments, insurance companies. Basically, institutions that are managing your money. Here's the metaphor I want you to remember. Imagine you lend your friend $100. He promises to pay you back in a year with 2% interest, so you'll get $102. Simple enough. But then, inflation hits. Prices go up 20% that year. A year later, your friend hands you that $102. Technically, he kept his promise, but that $102 can no longer buy what $100 bought when you lent it. In real terms, you lost money. You got paid back with cheaper dollars. Now replace your friend with the US government. Replace you with everyone who bought treasury bonds, including the pension fund managing your retirement savings. Replace $100 with $39 trillion. That's the game being played right now.
So what does the government do about this? Well, here's the surprising part, and this is the reveal most people never connect. They don't actually have to pay it back. Not really, not in the way you'd imagine. What they can do, what historically governments have done, is let inflation quietly eat away at the value of that debt over time. If inflation runs higher than the interest rate they're paying, every year that passes, the real value of that debt shrinks. They borrowed expensive dollars. They pay back cheap ones. And that sounds great for the government. It's actually a pretty elegant solution to their problem. But here's the part that should make you sit up straight. If inflation is being used as a tool, even accidentally, even as a byproduct of policy, that same inflation is eating your savings at exactly the same time. Right now, the average savings account in America pays around 4 to 5% interest.
Sounds decent, right? But if real inflation, the kind you actually feel at the grocery store, at the gas pump, at the rental office, is running higher than that, your savings account is lying to you. The number goes up, but what that number can buy goes down. You're working harder, saving more, and quietly getting poor.
And it gets worse for some people more than others. Look, if you already own a home with a fixed mortgage, you're actually sitting in a surprisingly good position right now. Your payment stays the same every month, but inflation makes every dollar you pay worth a little less over time. In real terms, your debt is shrinking. Meanwhile, your home value is probably going up. You borrowed expensive dollars, you're paying back cheap ones. Sound familiar? Same thing for people with fixed-rate student loans. If inflation stays elevated, the real burden of that debt gets lighter every year. But if you're a saver, if you're a retiree living off a fixed income, if you're a young person trying to buy your first home, here's the thing. This is where it gets genuinely uncomfortable. When the Federal Reserve cuts interest rates, which they've been doing, banks pay you less on savings. If inflation outpaces what your savings account earns, you are losing purchasing power, silently, every single month. And first-time home buyers? Look, this one really gets to me, because people hear rate cuts and think, great, mortgages will be cheaper. But that's not how it works. Mortgage rates are tied to 10-year Treasury yields, and those are set by the bond market, not the Fed. When investors think inflation is going to stay high, they demand higher returns on long-term bonds to protect themselves. Since September 2024, the Fed has cut rates 6 times, and over that exact same period, the 10-year Treasury yield went up, not down, up. Right now, the 30-year Treasury yield just hit 5.13%. That's the highest since 2007. The bond market is telling you something the headlines aren't.
So, what do you actually do about this? Because I'm not here just to stress you out. That's not the point. The point is that you now know something most people don't. And knowledge without action is just anxiety. First thing, look at where your money is sitting. If it's in a standard savings account earning 3 or 4%, while real inflation is running higher, you need to have an honest conversation with yourself about whether that money is actually working for you or just slowly losing value in a fancy-looking account. Second thing, think about assets that move with inflation rather than against it. Real estate? If you already own property with a fixed mortgage, you're already there. Equities, stocks in companies that can raise their prices as costs go up, have historically outpaced inflation over long time horizons. And for those who want something more direct, Treasury inflation-protected securities, TIPS, are literally designed for this. They adjust with inflation. That's their whole job. Third thing, and I want you to really hear this one, stop assuming the next 10 years will look like the last 10. The low-rate, low-inflation era that made everything feel stable from 2010 to 2020, that environment is gone. The rules have changed, and the people who figure that out early are the ones who come out ahead.
Here's the bottom line. You didn't create the $39 trillion debt. You didn't vote to run deficits for 40 years. You didn't set interest rates or print money or issue a single treasury bond. But you are going to feel it in your rent, in your groceries, in your mortgage payment, in the purchasing power of every dollar you've worked to save. The question is not whether this affects you. It does. The question is whether you're going to keep scrolling past it or whether you're going to spend the next 6 months getting yourself positioned before the next wave hits. The people who understood what was happening in 2008 before the crash, not after, those are the people who came out of it stronger. The people who understood what low rates meant in 2020 bought assets before everything exploded in value. The information is in front of you right now. The window is open. What you do next is up to you. If this video made you think differently about your money, hit subscribe, because this is exactly the kind of stuff we break down here every single week. No fluff, no fake promises, just the honest, real picture, and what you can actually do about it. I'll see you in the next one.